ones. This is Wahid. In this video, we are going to discuss about basics of investing in stock market with Muthu Kumar sir, who has done M.Tech in mechanical engineering, pursuing PhD in aeronautics from IIT Madras. So, please welcome sir.
Hello everyone, I'm Muthu. So here I'm here to give a basic introduction for those people who are interested in investing. So basically, I want to give what I'm going to give in this lecture is what is the need to invest, what are the instruments for investing, and how you can approach investing, like which is the right time to invest and what is the right instrument to invest. So this is what I'm going to tell you in this lecture. So let me get into the lecture. I'm sharing a screen. First thing, what is the need to invest? For this, I am taking you to a lecture in zeroth varsity, which tells you what exactly is the need to invest. So, I guess better it to share my entire screen. So if you look at it, this is a lecture series in zeroth varsity, which I recommend you to read a few modules of this one, basics of investing and fundamental analysis. Before that, I'll tell you a few excerpts. I'm taking it from this lecture to tell you what is the need to invest. First thing, assume you are an employee, earning 50,000 per month, which is when I'm telling you what exactly been given here. And you're spending 30,000 and remaining 20,000 you are saving it. Okay, so for example, you are getting a hike of 10% and there is a cost of living increase in India is 8%. Inflation in India is approximately 7 to 8%. So every year your money value decreases by 8%. That's all I can say in simple words. So for example, in case you are not investing in any instruments, so whatever you are earning, apart from spending, you are saving it or keeping it as a cash or in your account. In that case, say for example, you are doing this for next 20 years, where your income starts from 50,000 per month and it keeps increasing at a rate of 10% every year. And your savings is out of that, you are saving out of 50,000 you are saving 20,000 per month, and that expense rate increases, yearly surplus inflation rate increases at 8%. If you do not invest that surplus amount in any instruments for next 20 years, the amount of money that gets summed up is about 1.7 crore. So in case instead of say keeping the money in your account, you are deciding to invest in some instrument. So here you are investing it in some instrument which gives a growth of 12%. So in that case, if you are doing that amount which you are saving at the end of every year, if you are investing in some instruments, say for example stocks or mutual funds or bonds, whatever it is, so it grows at a rate of 12%. Assume is 12% is bit in the upper side. I would recommend 10%, but here for an example, he has used 12%. So at the end of 20 years, you will be having a cash of about 4.3 crores. So that's the difference. The main reason why you want to invest is basically you want to beat the inflation. Okay, whatever you earn this year will not be the same amount next year. Money depreciates, right, because of inflation. Then the secondary thing is creating wealth. So as I told that if you do not invest, the amount will be remaining as 1.7 crores. But if suppose you have invested in some instrument and you are prudent enough to invest at the right time, this 12% is achievable and you will be having an amount of 4.2, 4.3 crores almost at the end of 20 years. So that's the main reason for investment. Okay. Now I am taking you to, you're able to see my PPT. So now I am telling you the types of investment options. So since we have found that the investment is very important to beat the inflation and create wealth, we can invest in the following options. First is fixed income instruments. And next one is equity in real estate and commodities. For fixed income instruments, I will suggest the FD by banks. Literally, they give it's a no risk instrument, which we all know, and it can give you up to 6% max if you're investing in some fixed investments. So, like the types of investment options are, as I told, fixed income instruments are something like fixed FD, fixed deposit in banks, and bonds, debentures. So bonds are issued by government agencies. I'll tell about it later, but now I am telling you the types of investments. Then debentures, bond funds, equity. Equity is something like you can buy stocks directly, like of a company through brokerages. Then equity investments through mutual funds. So same, instead of you taking risk of buying in company stock, buying a company stock, you can like invest in mutual funds. They'll do the same, like they'll invest in equity stocks and they'll generate revenue for you. Okay, then real estates are buying and selling land. This is purely subjected to what you call your understanding of the value of land and the possible growth of that particular place. So it is a risky investment, actually, I could say. Commodities, it's gold and silver, bullion commodities. Gold and silver also, like, it's a good investment, but it doesn't give that high returns if you invest at a wrong time. Because if you had invested at the beginning of this corona, this would have been a great investment, but at present it is overvalued and it is not the right time to invest in gold. But I'm not going to give much information about gold commodities. I'll be like giving you more information about equity and fixed income instruments, which like how you can switch between either of that based on the current scenario of the market. So, like, first, basically this investment in stocks comes just because a company wants to generate money for running for expanding their company, or like increasing their sales growth, etc. Okay, so first what happens, when a company wants to raise some money, what they do, they'll be like approaching analysts, banking, investment bankers, where they will evaluate their company based on the company valuation. An IPO, the price for each share will be fixed by the analyst. So once a share price is fixed for that particular company, this particular company comes into pre-market stage, where investors like us, we are called as retail investors. Investors who invest less than 2 lakhs are called retail investors. Investors who invest more than 2 lakhs are called institutional investors. Okay, so there are certain quota for institutional investors as well as retail investors. Certain percentage. Say, for example, if a company is issuing 1,000 shares, they'll allocate, say, for example, 400 shares to retail investors who are like us, who will invest less than 2 lakhs, and some 600 shares to institutional investors like big mutual funds, banks, etc. Okay, once IPO is been available in the pre-market, we can apply for it. We can apply for it through brokerage portal or through bank. Okay, through net banking also you can apply. Through banks also you can apply. Sorry, through net banking or through brokerages you can apply. So once you put your interest, you can actually subscribe for one lot or multiple lots. So what happens once so many people have applied for it? What they do a lot allotment. It's not like first come first serve. It's like say for example 1,000 shares are there, some 10,000 applications have come. So what they do, they can give it's 1:10. So 1 out of 10 will get the this allotment. So this purely lot basis. So you can get it, you may not get also. So for example, last I have applied for 7-8 IPOs in last 1 year. I have got only 2 IPOs. So rest I did not get. So it's based on lot basis. Okay. So once the allotment is finalized, we'll be getting the shares in our demat account on the day of listing. For example, today they have given you that they have confirmed that you have got a lot of the shares for that company. What will happen? So the pre-market stage is done. So the share will be the company will be listed in either NSE or BSE on the specified date. Okay, the specified date. So once it is been, say for example, today the allotment is finalized, they'll be like listing the stock in the stock market NSE or BSE on 10th. Okay, when they're like listing on 10th, you will be getting your stocks in your demat account. So for example, general rule or thumb rule is, for example, if suppose 1000 shares have been issued by the company and some 10,000 people have shown interest for that stock, okay, means that many people are showing interest, and the IPO price might be fixed per share, like say it is been fixed at 10 rupees per share. Since the number of people who have shown interest are about 10,000 people for 1,000 shares, on the day of listing, the share price will be much higher than 10 rupees. Though you have got the share for 10 rupees in the pre-market, due to like it's a lot basis allotment, once the share is being listed in the stock market in BSE or NSE index, the stock will trade at a much higher price, more than 10 rupees. Say 15 rupees or 16 rupees. On the day of listing itself, you'll be gaining some 50%. But if suppose the stock is not been very well received at the time of IPO, out of 1,000 shares, only some 1,500 people have applied, or only 1,000 people have applied. Everyone will almost get the stocks. IPO, everyone will get the IPO, but on the day of listing, the stock won't be listed at a higher price. So for example, I told you, right, I got two IPOs. One is government, like IRFC finance one. The other one, so this Happiest Minds IPO, when I subscribed, the subscription price was around 160 rupees. Okay. So now on the day of allotment, it's on the day when it was allotted to me, the stock price was 150 rupees, 164 rupees exactly, I guess. So on the day of listing, it listed at 330 rupees. Okay. On the day of listing itself, I got more than 100% profit. But since this company is good, I did not sell this stock, but I held the stock. Now it has grown decently well, and it is now trading at 585 rupees. This is one sort of good investment which I consider, because at the time of application itself, for one share, almost 100 people applied. So this was, I considered it as a good investment. So I did not remove the stock. But there was another stock that's been released that came into public. It was IRFC, I guess. The company name I exactly forgot, but it was not subscribed well. And the allotment price was 25 rupees. When it got listed in the market, the price listed was 1 rupees less than what I got. But I was not confident with the stock that it will grow further. So I sold that stock for some loss. Okay. So this is the way IPO or a company comes into market. Mostly these kind of IPOs come very rarely. The chance of getting an IPO is very rare, to be frank. But so when you want to invest, you have to invest in the companies which are already listed in the market. At present, if you want to invest, you can invest only in the companies which are at present listed in the BSE or NSE index. Okay. For that to happen, so there are certain generic observations which you can make for understanding for investment. So I'll tell you about it. Before going to this depth instruments, I'll tell you how to choose a company.
So friends, hope all of you gain a minimum knowledge on stock market. This series will continue on next week. On that day, we are going to discuss about how to select a company to invest. So don't miss the next episode. Until then, bye-bye. This is Wahid signing off. Have a nice day too.
ఇంతవరకు మీరు మా ఎంజీ నెట్వర్క్స్ని సబ్స్క్రైబ్ చేసుకోకపోతే కింద కనిపిస్తున్న రెడ్ కలర్ సబ్స్క్రైబ్ బటన్ని ప్రెస్ చేసి పక్కన వచ్చే బెల్ ఐకాన్ని క్లిక్ చేసి ఆల్ మీద ట్యాప్ చేయండి. ఇలా చేయడం ద్వారా మేము అప్లోడ్ చేసే ప్రతి వీడియో నోటిఫికేషన్ మీ మొబైల్కి వస్తుంది.